The third to last class, your project is due next Monday. Numbers are due Sunday. So by now you heard that enough times from me. Couple of things on the project. One is, and I've said this before, this is not just about presenting the numbers you get on your company, because that comes out of a spreadsheet. It's reading those numbers and telling me basically you're spinning a narrative for your company. What does it do well? What does it do badly? What could it do better? Right? And don't make up things that it can do better just to make up things. If it does everything well, just say that's what it does. So that's basically what I'm looking for in the project. Any questions on the logistics of the project or the final exam? Okay. So let's talk about where we left off. We're talking about BP, right? Had a dividend problem. And eventually it came to a head. They had to cut dividends and the stock price dropped. But if you think about why the problem became as big as it did, it's because they didn't deal with it early enough. If they had dealt with it in 85 or 86 or 87, it wouldn't have come to an end. So let's talk a little bit about companies that get into a dividend problem and perhaps manage it a little better than BP. So I'm going to start with the study that looked at dividend cuts. We've all agreed that dividend cuts tend to send a signal to the market reacts badly. Is there a way you can package a dividend cut to make it more palatable to the market? So what the study looked at was companies that announced a dividend cut with other actions that go with it. Because you almost never get a company saying, we're going to cut dividends. It's usually other news that goes with it. Let's start with the first one. You have a dividend cut, and it comes with an announcement that earnings are also down. What do you when you're an investor in the market, the company cuts dividends, the earnings are also down. Of course, you're going to assume the worst. So the stock price is down, and it stays down for the announcement period. But in the quarter after, it does bounce back a little bit. If you have a prior announcement of an earnings decline, it continues into the announcement period, but the quarter after, again, you see a bounce back. But if you have a dividend cut that you accompany with other things you plan to do. So let's say you're cutting dividends, not because you're going through a bad period, your earnings are down, but because you have investments you have to make. Remember that company that got into a dividend problem because the business itself had changed? You need to package the dividend cut with something else. In this case, say, look, these are the things we want to invest in and hope that the market eventually comes to its senses. Initially, the market still reacts badly, but if you look at the quarter after, you see a much bigger bounce back if there is, in fact, something else you're going to use the dividend for. So you can't package this any better. I mean, when you have a dividend cut, it's always going to be a negative reaction. That's almost a given. It's what you can do afterwards that you're looking forward towards. So let's look at a couple of final examples and we'll wrap up dividend policy. During this period, 1992, the Limited was still this high growth retail firm. It's kind of laughable when you look back that the Limited and the Gap used to be high growth companies. The Limited was a high growth company. And between 1983 and 92, its free cash flow equity on average was minus $34 million a year. Let me pause right there. If you have a company with negative free cash flow equity and asked you, how much should this company pay in dividends? The answer is, hey, it shouldn't pay dividends. It's a great growth company of great projects. Why would it? But if you look at the Limited, on average, it paid about $41 million in dividends. Now, I don't know the inside story, but I'm going to at least guess on how the Limited got into this pathway. Somewhere early in this game, they had negative free cash flow equity, and they're visited by a banker. That's never good news. And the banker says, look, you're not paying dividends. And if you don't pay dividends, there are some investors who cannot buy your stock. Is that true? Yeah, there's some pension funds that are restricted to buying only dividend paying companies. So here's what the banker says. Pay a little bit in dividend, a token dividend, because then it'll allow those investors to buy your stock. It'll increase the demand for your stock and push up the stock price. Sounds alluring, right? Would you fall for it? What's the problem with paying just a token dividend? How did I describe those people who bought BP stock? dividend addicts, right? What happens when you give an addict a token shot? It never stays a token shot, right? They come in, you give them the token, they want more dividends and still more. The Limited started paying $1 million in dividends. The token dividend, by the end of the period, they were paying $50 million in dividends. If you can't afford to pay dividends, don't open the door to investors who like dividends. They're not suited for your company. So as you look at companies that have negative free cash flow equity that start paying dividends, no matter how good the reason, it doesn't make sense because you're attracting an investor clientele that's unsuited for your company. So why do you think Facebook and Google started paying dividends this year? Are they trying to? Their existing investors probably don't like it, right? But what are they trying to do, you think, by starting this dividend policy? I think they're trying to change their dividend clientele. I think they want a different investor base going forward. And it's a good, healthy thing to start the process and you control the process. Final example is Tata Motors, part of a family group, right? If you look at their free cash flow equity, it's actually negative. And even if you bring in the debt, you're basically looking at, at least without the debt, a huge negative free cash flow equity. With the target debt ratio, it's about 48 million. Their actual dividends plus buybacks is 75 million. Again, like the capital structure, we found Tata Motors was over levered. It looks like Tata Motors is paying a little too much in dividends, at least relative to its free cash flow equity. Now, that might be here by design, but they're not under levered. So you can't say they're using the debt to push towards a target debt ratio. But just as with capital structure, with family group companies, it becomes difficult to decide whether the company is doing something that doesn't make sense or whether it's doing something that advances the interests of the family group. Let's say the Tata Group, right? You might want to take cash out of companies that you think are not high growth, promising companies and put them into companies that have much better prospects. For the Tata Group, that was Tata Consulting Services, where the growth and the returns were. So for all you know, they're using this company as a way of channeling cash out of low growth companies into higher growth companies. You create an internal capital market. The only problem is these are all independent companies, and the shareholders essentially are seeing wealth transferred from one company to another. So with each of the companies, basically we follow the same path. We look at the free cash flow equity, we look at the dividends, we look at the quality of projects, and we make a judgment. So if I were to put my 5 companies on a matrix, here's where they would stand. Baidu has cash surplus, pays no dividends, but it's probably going to be left alone. It's a company with great returns. Deutsche Bank has a cash deficit and has poor projects. This is your worst possible scenario. You don't even know where to start because clearly the company has an operating problem. Now, other 3 companies all bundled together, they have decent projects, but they're returning too much cash. Okay? Some because of buybacks, in the case of Disney, and that's going to be easier to fix, just buy back less stock. Some because they pay high dividends, and that's going to be tougher to change because people get used to dividend policy. So for each of your companies, that's going to be the dividend section. You're going to start by looking at what your company has actually paid out, dividends and buybacks, and the answer might be nothing, like Baidu. Then you're going to look at what they could have returned, the free cash flow equity. And my suggestion, as I said in the last session, is to do it over a period, 5 years, 10 years, so you can see what the aggregated values look like. And then I'm going to ask you a question. Do you trust the management of this company? What kind of projects does it have? It's a subjective judgment, but by now you've already done the investment analysis, the capital structure section. You should have the ammunition to say, I trust my company with my cash. And if the answer is you trust the company, just let it go. If you don't, then at least alert the company to the fact that investors might start to demand that cash back. Any questions on dividend policy? Any aspect of it? Now, of course, like capital structure, the most common way in which companies set dividends is by looking at the rest of the peer group. So what I've done here is looked at the dividend yield and payout ratio for my 5 companies relative to my comparable group. And I've defined my comparable group in terms of yield and payout. So if you look at Disney, 1.09% dividend yield, the peer group is 0.96%. payout ratio of about 22%. It looks like very much like Disney is keeping up with that peer group, right? If you look at Vale, if you look across the board, you can see that they all have the same issues: high dividend yields, high payout ratios, because commodity prices were down across the board and they were all doing the same thing, which is paying dividends and hoping that earnings would bounce back. For Tata Motors, the payout and the dividend yield were lower than for the peer group, which kind of makes sense because they're an Indian automobile company. Maybe they see more growth prospects. But already you can see even within peer groups, you might want to control for differences between your company and the peer group. Deutsche, of course, is a disaster in a sector full of disasters. So I don't even know what to say when you're paying out 360% of your earnings as dividends. But that's what happens when you get stuck with the dividend policy set way back in time when you're a much better company. You know how to get out of it. With Disney, though, I did take a closer look at the peer group because it's such a diverse group. You have small companies, big companies. In fact, Disney and Time Warner kind of stand out in this group. So I wanted to see what, and you can see the differences in dividend yield and payout ratios across even the peer group. Remember with the capital structure, we looked at what caused differences in debt ratios. You can do the same thing with dividend yields and payout ratios. What causes differences in yields and payout ratios? You can look at growth rates and how risky the company is. So as with capital structure, the last thing I did was I looked at all US companies, the 2014 number, but you can get the 2025 numbers if you're interested, across the entire US market. In other words, I looked at what drives differences in dividend yield and dividend payout ratio across the market. And the variables I used, I think make sense. I looked at beta. High risk companies should have lower dividends. I looked at growth. High growth companies should have lower dividends. And I also looked at how much they had as debt, because if you have a lot of debt, maybe that also means you have higher cash flows and you can pay more in dividends. And it turns out that all of those variables explain differences in dividend yield to different degrees. Okay? And if you plug in Disney's numbers into the payout and yield, you get an estimated so their actual market debt is for 11.58, but if you plug in the numbers into their predicted payout ratios, you get predicted payout of 27%, predicted yield of 1.4%, which is pretty close to where they are. So my conclusion is, given how other companies in the US are paying dividends, Disney's yield and payout ratio look consistent with the rest of the market. So kind of an expanded peer group discussion. Which brings me to the last part of this class. Through all of this class, what do we say the objective in corporate finance is? Maximize the value of the company, right? But we've really never grappled with valuing an entire company. We kind of in capital budgeting, but we've never actually valued an entire company. So I'm going to start with a quote from Oscar Wilde, which I think cuts to the heart of what we'll talk about as value versus price. He described a cynic as a person who knows the price of everything and the value of nothing. You can replace the word cynic with a trader, and you could probably make the same statement. Traders know the price of everything, they know the value of nothing, but it doesn't matter, they trade on the price. So I want to spend the rest of this class kind of filling in that last gap. What is it that drives value? How do all of the things we've talked about in corporate finance play out in that value? So we're going back to the top again. We started with maximizing the value of the firm as an objective. Let's go back and talk about what it is that drives the value of a company. I know, how many of you are in my valuation class as well? I know quite a few are. So I'm going to give a compressed version of my valuation class. And the reason I'm going to give you a compressed version is, as some of you have heard, I am going to be on sabbatical next year. And I'll also tell you why I'm on sabbatical. It's, usually people take sabbaticals to write a book or do serious research. I'm not interested in writing another book. I have no serious research to do. I'm taking a sabbatical because my daughter's having a baby in a couple of weeks. Actually, it's due next Tuesdays. And she's a school teacher, so she can't really afford daycare. And I'm going to be childcare specialist for a year. And I'm really looking forward to it. Lots of diapers to change, but I will not be. So I wanted to give you a compressed valuation class in the next session and a half. You'll get a full valuation class if you're interested. Somebody will teach it. But Let's talk about valuation. Right? I start my valuation class by saying there are three ways you can attach a number to something. The first is what's called intrinsic valuation. You might see it called DCF, but I'm going to talk about it as intrinsic valuation. You value something based on its cash flows, its growth, and its risk. The second way you can attach a number to an asset is by looking at what other people pay for similar assets. It's called pricing. If that sounds obscure, think about how you decide how much to pay for a house or an apartment. You look at other apartments in the neighborhood, you look at what people pay for them, and you decide how much to pay for your house or apartment based on pricing. 95% of what you see called valuation out there is pricing. So I'm going to draw a distinction between those, and I'm going to talk primarily about valuation in this class, but you can fill in the gaps on what would somebody who's interested in pricing look at. And the third way you can put a number, and this is the part of valuation that's relatively new. By relatively, I mean 50 years old, is you can attach an option pricing value to an asset if it has a contingent cash flow. I don't want to be mysterious, but let's say you're valuing a young biotech company, young pharma company. It's got a blockbuster drug working its way through the pipeline. Whether it makes money depends on whether the drug gets approved. That's a contingency. You can argue there's an option in there. I'm going to focus primarily on intrinsic value because the end game in corporate finance is to maximize the value of the business. Now, if markets are efficient, price and value should converge sooner or later. You can say about maximizing value, I'm hoping that the price catches up, but you're hoping. It might not happen in the near term, so you might go out and do things that are right for your company, but the market might punish you. Conversely, you can go out and do things that are wrong for your company in terms of value, and the market could reward you. You could throw billions of dollars into bad projects, but because it's AI, your stock price gets pushed up. Yeah. So as a manager, I think your obligation is to maximize value and then try to talk the market into getting the price to be in sync with the value. But there will be times where you will do things that are right for the company and they work out to not increase the price. It's a tough call because as a manager, you get judged based on market price, not based upon value. But in corporate finance, at least the focus is to stay on value. So let's set up the big picture perspective here. We make discounted cash flow valuation more complicated than it needs to be. It comes from that very first class we all get in finance. The value of an asset is the present value of the expected cash flows in the asset, right? So an equation, that's the entire theory for the class. Value of an asset is the present value of the expected cash flows. The numerator are expected cash flows. Not best case, not conservative, but expected cash flows. And in the denominator is a risk-adjusted discount rate. So ultimately, the value of any business, any asset, comes from its capacity to generate cash flows. That's not debatable, right? I don't care whether you're an AI business, a young business, an old business. Ultimately, I value based on your capacity to create cash flows. Second, how quickly you can grow those cash flows. And third, the risk in those cash flows. So I know that we tend to think in terms of discounted cash flow valuation as the value of a business, but there are two ways you can frame a discounted cash flow valuation when you're looking at a company. And if this sounds familiar, it's because we also did this when we did capital budgeting. The first is you can focus on just the equity cash flows and discount them back at the rate of return that equity investors want. And by now, we have a way of framing both of those things. What do equity investors require when they invest in a company? It's a cost of equity. What are the cash flows they get from a company? Strictly speaking, dividends, but as we said in the dividend analysis section, it could be free cash flow to equity. You discount cash flows to equity at the cost of equity. You value the equity in a business. But there's another way you can approach valuation, which I think is more general. Rather than focusing on just what equity investors get, you can look at what both lenders and equity investors get from a company. Let's play out a game. You guys are going to lend to the company, you're equity investors. Equity investors get free cash flow equity, whatever cash is left over after debt payments. What do lenders get? They get interest payments, they get principal payments. That collective cash flow you get is called the free cash flow to the firm. And if that is the cash flow I'm discounting, the discount rate I use should be the weighted average of what you want, which is the cost of equity, and what the lenders want, which is the cost of debt. That sound familiar? That's the cost of capital. Cash flows to the business, discounted back at the cost of capital, gives you the value of the entire business. So let's set the structure up. When you value equity, you're focused on just the equity investors. You're wearing blinders. All you care about is cash flows to equity. And the free cash or equity that we did in the dividend policy section becomes the cash flow you're looking at. You discount it back at the cost of equity. You get a value of equity in the business. Now, the only problem with free cash or equity is you're making judgments on what capex and depreciation and working capital will be and debt payments. So the alternative, the strict version of the model, is the dividend discount model. It's the oldest discounted cash flow model in use, and it's an equity valuation model. So that's the first approach. The second approach, you take the cash flow to the firm, pre-debt cash flows. And I want to emphasize, it's got to be cash flows before debt payments because lenders are now part of the capital providers. You look at the collective cash flow you get, you discount it back at the cost of capital. What you get is the value of the entire firm. I'm going to use both so you can see them both play out. But they're both perfectly acceptable approaches. And if you do it right, you'll get the same value for the equity, whether you value the equity directly or whether you value the firm and subtract out the debt due to the firm. So let's set the table. Okay? You sit down to value business. What are the drivers of value? First, you're going to look at the existing investments the business has made. Look at the cash flows you get from those businesses. So if you've taken 10 projects, you have 3 products out there, you look at the cash flows in those products. Okay? Second, you're going to look at the value of growth you get as this company. And I want to emphasize the word growth by itself is neither good nor bad. It has 2 effects. The positive effect is growth increases your revenues and your earnings. That's a good side. The bad side of growth is you have to reinvest to create that growth. You got to build factories, you got to invest in R&D. So the value of growth captures how much growth will add or destroy in value as you try to grow. Risk in a discounted cash flow model shows up in only one place. It's in the discount rate. People don't like it, but that's where it's focused. So if you're a riskier set of cash flows, I'll use a higher discount rate. And finally, one of the problems you'll face when you value companies is companies, at least in theory, can last forever. And we can't estimate expected cash flows forever. So we put closure in the model by assuming that at some point in time in the future, your company will start to grow at a rate it can sustain forever. You know what that buys you? It buys you an infinite series in mathematics. An infinite series in mathematics 200 years ago, somebody solved for the value of that series. It becomes a terminal value equation. You see, it allows you to capture the present value of cash flows beyond. We use this even in the context of capital budgeting. If you remember the Disney theme park, we got to year 10, so it can go on. And we used a terminal value equation. In discounted cash flow valuation for companies, you almost always have to bring that into play. So cash flows from existing assets, value of growth, risk, and what happens in steady state. Now, if most of you think about valuation, you think of numbers in a spreadsheet, in big Excel spreadsheets. Especially if you worked at banks, these spreadsheets can have 50 worksheets all connected to each other. So I'm going to kind of step back from that and talk a little bit about something I learned in the process of doing valuation that has changed the way I think about valuation. In every valuation, there are stories people and number people. Stories people tell you great stories about the business. Numbers people are the ones who grind through the numbers, put in growth rates and inputs into spreadsheets. A good valuation is a bridge between stories and numbers. You're saying, what does that even mean? Take an example. I valued Tesla just a few weeks ago, and I gave Tesla $500 billion in revenues in year 10. So if you look at my Excel spreadsheet, there's 500 billion in revenues. Let's say you point to those revenues, say, why 500 billion? I could give you one answer, which is an entirely numerical answer. And I say, look, I used a 25% growth rate for the next 5 years and 15% thereafter, which tells you absolutely nothing. You know why you should be a little skeptical about the 500 billion revenues? What's the largest automobile company in the world in terms of revenues right now? Volkswagen and Toyota are pretty close to each other, about 300 billion revenues apiece. Already I'm making Tesla larger than the largest automobile company in the world today, right? The onus should now be on me to explain how they get to 500 billion. They could stay an automobile company, but that'll require selling about 15 million electric cars, maybe even 20 million electric cars, which is going to be a really hard push, especially because the portion of the car market that's electric cars is small. And even if it grows, this will require a huge market share. And if you bring BYD into the picture, I don't think they can pull it off. Almost by definition, a $500 billion revenue story has to also bring in other ways in which Tesla could make money. And with Tesla, those other ways start to multiply, right? What are some of the other ways Tesla could make money beyond just selling electric cars? And this is the most talked about company. You probably read a tweet about what they can do. What are the other ways they could potentially make money? Robotics, Optimus, so that's it's way out there, but you could argue. And how would that become a moneymaker? What would Tesla have to do with robots for them to make money from robots? Either sell it to manufacturing companies and companies that have a lot of things that robots could do. So that could be one. What else? Yes. Batteries, in which case they will sell their electric car batteries into, so that's expanding into energy, home batteries that you could use. So maybe there's an energy business inside, which they already have through First Solar. They can expand that business. Anything else? That's going to be interesting, right? Because if you become the default network, maybe at some point in time, even if you have other manufacturers' cars, you might have to pay for charging at a Tesla net. So there's a charging network. We're starting to multiply business. Was one more, which I've heard. Yeah. Automated, and this becomes tricky, right? So let's flesh that out. What can Tesla do? Let's say this becomes a reality, right? How, what would Tesla need to do to actually make money on it? What are the ways it can take automated driving and make money? Place it to Uber. One is it can basically take the existing ride sharing companies. I took an Uber home last night. My flight got in at 3 in the morning. I feel a little dazed. I took an Uber home, and maybe they will make the cars, they will lease and split the proceeds with Uber. Because remember, one of the advantages for a ride sharing company having an automated driving car is, where does most of your fare go right now? 80% goes to the driver, right? Without a driver, you can say the entire 100% comes to the ride sharing company, and Tesla can say, it's our cars that are allowing you to do it, we'll take half. The advantage to Tesla is the ride sharing business is a nasty business. It's a logistics driven business. You got to deal with millions of people with complaints. Yesterday, I could see people at the airport complaining to Lyft, my car's not here. I don't think Tesla wants to deal with that. So the advantage of letting an Uber or Lyft do it is you don't have to deal with the logistics. You've taken an existing ride sharing company. You might be able to split the capital investment with that company, right? So they could say, look, you take half and I will take half. So it might be an easier way, because there are people who argue that maybe Tesla can be its own automated taxi company, but that's going to require doing what Uber does in addition to cars. So I can tell you a story of half a bit, but that's the kind of story you need to explain the 500 billion. I gave Tesla 16%, 12% margins. You give an automobile company double-digit margins, you're already pushing the limits of what an automobile company can earn. Why? Because you look at the median operating margin for an automobile company, it's about 4%, 5%, 6%. If you're a mass market automobile company, if you're a luxury auto company, you can earn 12%, 13, 14. But with the 500 billion in revenues, I've made Tesla a mass market automobile company, right? You can't be a BMW and get to 500 billion in revenues. So you're saying, how do you get to 12% margins? Here, I need a story of some part of Tesla's business, which is a high margin business, will allow them to push up margins. There's a story I did not hear as one of the other businesses, but anybody here own a Tesla? Okay. Don't worry. No, we're not going to pick on you. This is not that kind of class. But a Tesla, without its software, becomes just a heap of metal sitting in your garage. The company without its software, that becomes useless. Right now, the software gets packaged with the car when you buy the car. But even right now, there are portions of software that you can pay extra. The automated driving right now, if you want to get that extra package, is, I don't know how much it is, $99. Do you have a sense of what it costs? 199 a month? Wow. Okay. So, but you can see at some point in time, you might get a basic software package with your car and then get premium add-ons. You see where this is going, right? There might be a software business on the side. The advantage of software business is the unit economics. We're going to talk a little bit about this when we talk about estimating margin for your company are amazing because you can sell the next unit, costs you nothing. Margins are 40, 45, 50%. I think there's enough in Tesla's business model that will allow them to earn higher margins on some aspect of the business. Is this a big story? Absolutely. $500 billion in revenues, 12% margins. The rest of the story kind of blends in there. But with that big story, the value that I got for Tesla was $155 per share. This is a few weeks ago when it was trading at $240 or $230 per share. Just because you have a big story doesn't mean you're going to be able to justify the price, but your story has to lead. So every number in your valuation has to have a story attached to it. You can also tell big stories about your company too, right? In which case, my job is to find a number that goes with it. If you get a chance, you go to my blog, I have a valuation of Birkenstock. Anybody here own own a Birkenstock? Not shares. No. Why do you like Caleb? Why do you like Birkenstock? That's the only, I've never said they look stylish is never the answer. They look, they're comfortable, right? Now, so I'm going to, for those of you in my valuation class, forgive me for repeating what I said, but Birkenstock is 250 years old as a company. It was a business started by a German shoemaker in the late 1700s. And for the first 200 years of its existence, it was sold primarily to German. Now, when you have foot problems, you went into these clinics that treated foot problems. That's basically where it was sold through. And to show you how brand names are created through a series of accidents, in 1966, a German-American tourist went back to Germany, and she had foot problems when she was in Germany. She wore Birkenstock. She really liked them. She went to the owner of Birkenstock and said, I'd like to take these shoes back to LA because I think we could find a market there. He was very resistant. He's very German. He said, no, no, we don't do that. She said, no, no, let me take them back. She must have been very convincing because he let her take the shoes back to an LA store. And the rest, as they say, is history. Because a bunch of hippies walked into the store. And remember, the essence of being a hippie is you did what you didn't want to do what everybody else was doing. And in the 60s, everybody wore, even to baseball games, they'd wear suits and get dressed up and wear shoes that were uncomfortable. They said, we don't want to do that. Birkenstock became the symbol or the emblem that hippies used in the 70s said, look, we're not. And that caught on. So that was the start building block for their brand name. 1992, a 16-year-old model named Kate Moss wore Birkenstock on a Vogue cover, and it took off on campuses. Over time, celebrities adopted Birkenstock. Steve Jobs wore Birkenstock. His Birkenstock went on sale for like $260,000 a few years ago. So all of this built up to a brand name. 2 years ago, Birkenstock went public. And the big story about Birkenstock is look at the brand. It is going to affect value. Celebrity advertising for free. That's going to affect value. And about 10 years ago, Birkenstock got this amazing CEO. He came in because the family felt that it wasn't getting the most out of the company. They hired an outsider to come in, and he did amazing jobs. An amazing job at the company, basically by connecting the brand name with other brand names. There are Prada Birkenstock you can buy. You can go check them out on Google. It's like $1,500. He connected with big name companies, and he brought growth back to the company. I mean, what each of the things I've just described, the brand name, the celebrity advertising, the fact that you have great management would be viewed as intangibles, right? The stories we tell. So if you take a look at my blog, what I've done is taken each of those stories and said, this is where it'll show up in my valuation. The great management shows up in a high revenue growth rate because without them, I think the growth would be like 8%. With them, it's closer to 22%. The great brand name shows up in a high margin. Their margins are like 24%. The typical apparel footwear company has margins of about 14%. Celebrity advertising shows up as a much lower investment to get growth because these companies, to build brand name, have to pay people millions of dollars. Birkenstock gets that for free. And as a final bonus, in the summer before Birkenstock went public, the Barbie movie came out. Now, how many of you saw the Barbie movie? Remember Barbie wears pink Birkenstock? I know you don't remember, but go watch the movie again. In the summer after the Barbie movie came out, Birkenstock sales jumped by 30% that summer. So in my valuation, I did a first year jump in the revenues, the Barbie buzz. Every single story becomes a number. So when you talk about valuations being bridges between stories and numbers, that's what we're talking about. You tell me a big story about your company, I'm looking for the number that goes with that story. It makes valuations far more disciplined and far more connected to the business. Because left to our own devices, we are going to wallow in our own delusions. Each of us, one part of this comes easier than the other, right? Some of us are more naturally number crunchers, some of us are more naturally storytellers. Left to your own devices, you're going to have your delusions as a storyteller or number cruncher. And you hang out with other people who think just like you, they won't seem like delusions. So as we go through this process, we'll talk more specifically about connecting stories, numbers, but every one of you, when you turn the valuation of your company, whether you like it or not, you're telling a story about the company. So let's set the process up. Let's look at the inputs that drive value and start working on these inputs. And as we go through, you're going to see much of the dirty work in estimating these numbers we've already done in the context of something else in corporate finance. So first, we're going to start by talking about cash flows. Those cash flows can either be before debt payments, cash flows of the firm, or after debt payments, cash flows to equity. They have to be after taxes and after reinvestments. We'll talk about how we bring them in. When we talk about growth, the growth rate can either be in equity income, net income, earnings per share, if you're looking at equity, valuing the equity in a company, or they can be in operating income, which is a pre-debt earnings number. The discount rate can either be a cost of equity if you're focused on valuing the equity in a company or a cost of capital. And in both cases, eventually you got to get to a point where you say, I'm willing to let the growth rate be constant forever. And we'll talk about the constraints on that growth rate and how it feeds in through a terminal value. What you get as a present value will either be the value of equity, if you're discounting cash flows to equity at the cost of equity, or the value of the entire business in terms of operating assets, if you're discounting cash flows of the firm at the cost of capital. So I'm going to take each of these inputs and use the companies that I've been talking about all through this class to talk about how those inputs will play out. So let's talk about cash flows first. Cash flows can either be cash flows to equity or cash flow to the firm. If you're talking about cash flow to equity, if you want to be lazy, you can just go with dividends. After all, that's the only cash flow that's tangible. But as we saw in the dividend section, at least with US companies, increasingly cash is returned in the form of stock buybacks. So you can take dividends plus buybacks. Alternatively, you can say, I don't trust managers to return what they can. If this looks familiar, that's my free cash flow to equity calculation that we just did when we did dividends. So that's how you can compute cash flows to equity. If you're talking about cash flow to the firm, it's a pre-debt cash flow. So I can no longer start with net income. I start with operating income, earnings before interest and taxes. I act like I pay taxes, and I'll talk a little bit about what I mean by act like I pay taxes on that operating income. It's called an unlevered cash flow. I act like I have no debt payments, no interest expenses. I look at after-tax operating income. And from that, I subtract out what I need to reinvest. The first is capital expenditures minus depreciation, the same item you saw in the free cash flow to equity, and change in working capital. Make up your mind early in the process as to whether you're going to be looking at equity or the firm, because everything you do through the process will be driven by that choice you make. So I'm going to start with dividends for Deutsche Bank and contrast it with, later on with free cash flows equity for the same company. So in 2007, when I was valuing Deutsche Bank, they were a healthy bank. They were a bank that looked like they could sustain themselves. I decided to be lazy and focus just on dividends. They paid out 2,146 million euros of dividends on net income of 6.5 billion euros. So they paid about a third of their net income out as dividends. In my 2008 valuation, I assumed that the dividends were reasonable and I could use the dividend discount model. But I'm also going to show my 2016 valuation where I'd lost trust in Deutsche to be able to pay the dividends that they did. By then, their free cash flow to equity had melted down. So I'll talk about when you can get away using dividends. And it's a very, very narrow set of companies where you can use dividends, and when you've got to give up on dividends and look at estimates of free cash flow to equity. For Tata Motors, I estimated the free cash flow to equity starting with net income. So I went back 5 years, started with net income. There's capex, depreciation, all of these items come directly out of the statement of cash flows. So I looked at, capex, depreciation, change in working capital. That's my reinvestment. Remember, debt pays for some of it. And again, it varies across time. But the total equity reinvestment they had over the period was about 88% of their net income. They're reinvesting about 88% of their net income back into the business. Again, I'm looking at the past. It's telling me nothing about the future, but this is going to become the ammunition I use to forecast the future. So free cash flow equity can focus either on dividends or free cash flow equity. Okay? And if you focus on free cash flow equity, you're getting a measure of potential dividends. For Disney, I wanted to go the firm valuation route. So to estimate free cash flow of the firm, I started with operating income. And in 2013, I had to do the adjustment for leases. Today, hopefully, accountants are doing it for you, so you don't have to do the same adjustment. So if you don't trust accountants, you can go back to a pre-lease operating income and do it yourself. You'll get pretty much the same answer. That's my operating income, 10,032. My tax rate for Disney. And remember, we talked about the contrast between effective tax rate and marginal tax rate. When we did cost of debt, which one did we say we always go with when we do cost of debt? The marginal, because interest saves you tax as a margin. Here, I'm going to suggest a different rule, and here's why. I'm looking at the tax rate that I'll pay on all of my operating income. It's not just on the next dollar. The effective tax rate is like an average tax rate across all of my income. So here, I think you can stay with an effective tax rate, at least in the near term. So I'm going to start with 31% as my tax rate. CapEx was 5,239 million. Depreciation was 2,192. So they've got about 3 billion in net capex, and working capital increased by 103 million. So let's work out free cash flow of the firm. I start with the 10,032, and here's where acting like I'm paying taxes comes in. I don't usually pay taxes on my operating income. I get to subtract out interest expenses, come up with the taxable income, and then pay taxes. I'm going to act like I have no interest expenses. That's why it's called an unlevered cash flow. You act like you have no interest expenses, which means you pay the tax, the effective tax rate, on the entire operating income. If you look at what I pay in taxes here, it'll be far greater than their actual taxes paid, because this is a hypothetical tax. So start with the after-tax operating income. I subtract the net capex and subtract the change in working capital. My free cash flow to the firm is about 3.2 billion. That's what I'm left with after taxes and after reinvestment. And again, here I'm going to do what I did with Tata Motors. I'm going to look at the percentage of my after-tax operating income that I put back into the business. Collectively, my net capex and change in working capital is 3,732 million. That's what they reinvest in the business as a percentage of my after-tax operating income. That's about 54%. Why do I care what a company reinvests? Why am I looking at a company's history of reinvestment? No. Clearly, it takes away from my cash flows. That's a bad thing. It makes my cash flows lower. But where will it come back into play in a valuation? Let's say you look at your company over the last 10 years, it's reinvesting nothing. That's good from a cash flow perspective. But when you project growth for this company, you're going to have to be much more cautious. If you're not reinvesting, you're not going to get growth. So this becomes an input into how quickly a company can grow. And that's why I'm tracking how much both Tata Motors and Disney are reinvesting. So cash flows are cash flows either after debt payments, if you're doing cash flow to equity, or before debt payments, if you're doing free cash flow to the firm. Discount rates, almost everything I'm going to say should sound familiar, because the discount rates in the prospective valuation are exactly the same discount rates we talked about in the context of corporate finance. So if you think about the different ways in which discount rates have played out in this class, In the investment analysis class, in the investment analysis section, what did the cost of capital do? What was the role of the cost of capital when we did capital budgeting? It became the hurdle rate on whether to take an investment. So we used to decide whether to invest in a Disney theme park. Then we got to capital structure. What is the role of the cost of capital, Leon? What the right? It became an optimizing tool. Then we got to dividend policy. What did the cost of capital help us do? We looked at the return on capital a company earned and made less than the cost of capital. We said this company should be paying out more in dividends, right? It became a divining rod in dividends. Now we're in valuation. The cost of capital becomes the rate of return you will need to invest in the entire company. It becomes a discount rate to value the whole company. Four different parts of corporate finance. Corporate finance comes in, cost of capital comes in each part separately. And that's why I call it the Swiss Army knife of finance. It's always there, used in different contexts, and you have to recognize where it's being used. So cost of capital and the cost of equity, the intuitive statement we made early on still stands. Riskier cash flows should go with higher costs of equity and higher costs of capital. Start of the class, we weren't clear how to measure risk, but as we went through, we defined risk through the eyes of the marginal investors with equity, the beta and the risk premium. With cost of debt, we defined it through the default risk and the default spread. Everything we said there still applies. The one thing, though, that you have to recognize when you do cost of equity and cost of capital for an entire company is companies can change over time. Unlike an individual project, where the project is given, companies can change over time. And because you're making those changes, you should be consistent about what kind of cost of capital you're using across time. So let's say you're valuing a company. It's entirely a US-based company now. But you believe that over the next 10 years, half of its revenues are going to come from Latin America. You know what your cost of capital should do, right? When you start, it should be based on a US equity risk premium. But as you move through time, your equity risk premium should change to reflect the geographies where you're going to be investing. You're valuing a company, it's in one business now, Peloton. Mostly, subscriptions, fitness equipment, but you think that it can create a third business. And you put that into your growth and margins, I expect your beta to change to reflect the third business you brought in. The one difference between cost of capital when you do capital budgeting, where you stick with the project and the company, is you got to be much more adaptable when you look at a company because the company itself can change. So I'm going to start by estimating my cost of equity for Deutsche Bank and Tata Motors because I'm doing an equity valuation of those two companies. In early 2008, I used a beta 1.16 for Deutsche Bank, looking at the average beta across commercial and investment banks. And remember, with banks, we don't unlever and relever betas because debt is not a source of capital. I used a risk-free rate in euros, 4% then, and an equity risk premium reflecting mature markets. My cost of equity for Deutsche in 2008 was 9.23% in euro terms. With Tata Motors, I decided to do everything in rupee terms. I start with a rupee risk-free rate of 6.57%. I know it's way back in time, but the way I got it was I start with an Indian government bond rate and subtract out the default spread for India. And when I did my cost of equity, I brought in the beta for Tata Motors, reflecting automobile company betas, and an equity risk premium reflecting where Tata Motors got its revenues. You remember, China and India were competing for the top spot. It's a weighted average. It's at exact same. So you go back and look at the capital budgeting section, you'll see that same number in the context of a hurdle rate when we looked at Tata Motors. For Disney, this page is actually a complete repeat of a page you saw at the start of the capital structure section. It's the existing cost of capital, risk-free rate 2.75%, T-bond rate. Beta is the bottom-up beta for Disney, and the equity risk premium reflects where Disney makes its money with the geographies. So my cost of equity is 8.52%, and my cost of capital, if you bring in the weighted average, the cost of debt, which is 2.4% after taxes, is 7.81%. I am using Disney's actual debt ratio. If any of you worked in investment banks, there's often this big debate that goes on within banks about whether you should use an actual debt ratio or a target debt ratio. The target is kind of, God knows where it comes from. My suggestion is you always start with the actual. Can you change it over time? Absolutely. If you believe this company's debt ratio is going to change over time, and I'm going to make that assumption, I will change the cost of capital over time. So when you do discounted cash flow valuation, your cost of capital is a number that should vary across time for most companies because your company is changing over time. In fact, for Disney, here's what I did. I didn't have much in terms of change. The beta did was pretty close to one. I think will stay close to one. I did assume that over time, the debt ratio would go from 11.5% to 20%. And one of the advantages of doing valuation of corporate finance class is by the time you get to the valuation section, you've done your optimal capital structure, right? You know that this company's excess debt capacity. You can make a judgment on whether the company will use the debt capacity. I think Disney will. So the debt ratio goes from 11 to 20%. And as the debt ratio changes, my cost of capital, which starts at 7.81%, the existing cost of capital, will decrease over time to 7.29%. So I want to emphasize that because often in discounted cash flow valuation, one of the challenges you will face is people think you get one shot at estimating the cost of capital and it stays fixed over time. But companies' cost of capital should change over time. Use that adaptability. So that's the big difference between capital budgeting project where you have one cost of capital. So with Disney theme parks, we stayed with one cost of capital. You value a company with the cost of capital can vary across time. Any questions on either the cash flow part of the discount rates? Which brings us to expected growth. There are three ways you can estimate the growth for your company. Easiest and the laziest way is look at the past and just extrapolate. Let's call that the chat GPT version, right? Because anybody can do that. You take the past, you just extrapolate in the future. The second is you ask somebody else what the growth rate will be. Any ideas on who that somebody else might be? Constantine, you're valuing a company, who is somebody else? Could ask. You could ask the management, right? And there is some basis for it. Do managers know more about the company than you do? Absolutely. Saying, let management tell me what the growth rate will be. What are the downsides of doing that, though? They could have no idea. Hopefully, they have some idea. Otherwise, you're in big trouble valuing the company. But even if they do have an idea, first, in most cases, when they give guidance, how long term is that guidance? Next quarter. So at the even when they give guidance, it's short term, it's not long term. And when they give long term guidance, is there some bias in what? Absolutely, right? So you could ask management what the growth rate is, but you have to take that with not just a little bit of salt, but a whole pitcher of salt, maybe a bucket full of salt. You know that when you do private company valuation, you ask most private company appraisers where they get the numbers for the future. The answer is we get them from management forecasts. I've never understood how you get away with it, but it's become established practice. So you can ask management. Who else can you ask? Kelly, who are you valuing? Is Lululemon followed by a lot of equity research analysts? Right? There are probably 35, 40 of them. They give, of course, forecasts for earnings for the next quarter, but they also, some of them, not all of them, and that's interesting, about half of them will give you 5-year forecasts. And they give 5-year forecasts. Which metric usually are they forecasting? Revenues, operating income? I would love for it to be revenue. I wish usually they forecast earnings per share. For some reason, they're very focused on earnings per share. They give revenue forecasts very rarely because they're not thinking of business model. They think about the bottom line. But there are growth rates, and you can say, look, they follow the company all the time. So they must know more about Lululemon than I do. So you're basically saying, I'm going to use the analyst forecast of growth. So you can look at the past, you can outsource your growth rate. But ultimately, for a company to grow, it has to do something, right? I can't go around endowing companies with high growth just because I feel like it. And there are two things that a company has to do to grow. And as I list the two, you're already going to see what limits growth at a company. One is, remember we looked at the reinvestment rate, which is the portion of your earnings you put back into the company. And as I did that, you said, as an investor, why are you doing it? You're reducing my cash flows. I'm doing it because one of the pillars on which growth is built is how much are you reinvesting. It's very difficult for a company that reinvests very little to grow a lot in the future. So what does reinvestment mean? You're taking your money and you're putting into projects. Does it matter what kind of projects you take? On capital budgeting, we want to take good projects. Do good projects, how do we define good projects? They either have positive net present value. If we use the shortcut that the return on capital is greater than the cost of capital, there are two things you need to do. You need to reinvest a lot and reinvest well at the same time. And already you can see why companies can pull off one half of the equation, but don't succeed with the other. There are lots of companies that reinvest a lot, but don't reinvest well. There are a lot of companies that reinvest well, but don't reinvest very. So getting both sides of that equation going is tough to do. It's easy to grow fast. It's really difficult to have quality growth because you need to pull that off. So the third way in which we're going to estimate growth is we're going to look at the company's fundamentals. How much is it reinvesting? How well is it reinvesting? Disney, I gave you a sense of how much was reinvesting, right? At least based on 2013, it's reinvesting about 54%. Do you have a sense of how well Disney is reinvesting? When we did capital budgeting, we did that tangent. We look at the return on capital of Disney of 12.61%, higher than the cost of capital. If they can maintain that return on capital, we now have the basis for making a judgment, at least, of whether Disney can continue to grow. So we're going to look at the fundamentals of a company to decide whether it can keep growing. At a generic level, though, I'm going to go through a process, and this is the spreadsheet you're going to use because I don't want you reinventing the wheel and building your own valuation spreadsheet in the last 2 weeks of this class. And this spreadsheet is not going to become a black box, I promise you, because it's built on 3 drivers of business models, and I want to talk about all 3 drivers. The first is revenue growth. We talked about Tesla, making small revenues become bigger revenues. What drives revenue growth? We'll talk about the inputs that drive that. The second is, what kind of margins will you make as a company over time? And the third is, how much will you need to reinvest to deliver that revenue growth? Every business model, I'm going to argue, can be boiled down to those 3 metrics. And we'll talk about what drives those 3 metrics. So if you have a company with stable growth and stable returns and stable margins, I'll give you a shortcut to get the growth rate. But use it only if you have stable margins. And for most companies, it's a really tough call to make. So let's talk about the generic way in which you can go about estimating cash flows. And as I said, the spreadsheet, it's called FCFF Ginzu, simple Ginzu. Basically, it's a spreadsheet that tries to bring it all together. It's built upon 3 levers. First is I'm going to ask you what revenue growth for your company. Your first reaction is going to be, I've never valued a company, I have no idea. That's not true. By the time you get to this, you've looked at your company for 12 weeks in the context of capital structure, dividend. You have a sense at least, is this a high growth company, an average growth company, or a low growth company? I'll give you some things to look at to make that judgment. But that's going to make your revenues change over time. Second question I'm going to ask you is, tell me what kind of margins this company will make in the future. For some of your companies, those margins can be very similar to today's margins. It's in steady state. You're valuing Costco, the margins are not going to change dramatically over time. It's an established company. You're valuing Chipotle, your margins might not change very much over time. You're valuing Kava, your margins might change. It's a high growth Mediterranean fast food chain. Its margins might evolve over time. And you say margins going forward will improve because of economies of scale. Okay. We're going to talk about estimating margin. The third input is, given your revenue growth, I'm going to hold you accountable. And here's what I mean by holding you accountable. Now, often I talk to founders about their business and ask them, what kind of revenue growth do you expect? What do you think the answer is? High, right? I say, okay. 80% a year, yeah, that's good. Even 120% a year. You say, okay, let me give you the bill. To grow 120% a year, what do you have to do? You have to reinvest a lot. And if you're a founder, what does reinvesting a lot mean? You got to go raise capital from venture capitalists. And what are they going to demand in return? A share of your business. And already you can see why bringing this up is going to sober founders on how much growth they want. Because to get 120% growth, you might have to give up 80% of your company. Say, look, I don't want to do that. Okay, then let's bring the growth down to 60% or 40%. Anytime you have a discussion about growth, you've got to bring in a discussion of what you have to reinvest to generate that growth. Otherwise, Revenue growth that becomes unconstrained. You're going to use whatever number you want to use to get to whatever value you want. Growth, margins, reinvestment. So I want you to think about your company and already start to think about those pieces, because each one I'm going to list some of the things you're going to look at to make a judgment. So Patrick, I want to pick your company for this. Who are you valuing? Okay. So let's start with revenue growth, right? First, is the market it's going after a growing market or a pretty mature market? Pretty mature market. And Mondelez is already a big player in that market, right? It's got a pretty big market share. Already you can see that your revenue growth is probably going to be more single digit than double digit, because you can't grow very fast if you have a 30% or a 25% market share of a mature market. But if you are doing this for a much smaller food company, let's take Celsius, small beverage company. So Coca-Cola, I can't do much in growth, but Celsius, I might say, look, it's a small company. The market is big. You can take market share away. So you're going to look at the size of the market and how much it's growing. And you're also going to look at your company's market share and whether that market share will change over time. Any of you doing a high growth company? You want to throw it in the mix? You can be a money-making company that's high growth, right? No, nobody doing a high growth company? Somebody must be doing a company where the market itself is growing. If you have a market that's growing, that gives you some leeway to have a growth rate. Apple and Samsung in 2010 had big market shares of the smartphone market, but they were able to grow 15% a year because the smartphone market was itself still growing. Today, you look at Apple and Samsung, you're not going to be giving them double-digit growth anymore because the smartphone market has leveled off. You can look at the total market and how much it's growing, and you can look at your market share. And as you look at the market share, you also have to explore what I call the industry economics. How is this business going to end up looking? Okay? Businesses can either be splintered businesses. We have multiple players, each taking small market shares. They can be winner-take-all businesses. And it's not something you pick. It's basically a business characteristic. But over time, businesses can evolve. 30 years ago, if you looked at the advertising business, hopelessly splintered business. The largest advertising company in the world might have had a 2% market share. Why? Because it was newspapers and billboards that were localized, geographically constrained. Today, two companies dominate that market. The two companies are Facebook and Google, right? Online advertising has changed the economics of the advertising business. Car service. 30 years ago, biggest car service company in the world might have been a taxi cab company in New York City with a 0.3% market share of the global car service business. Today, Uber and Lyft are increasing, and Didi and the other ride-sharing companies. Technology has allowed businesses that used to be splintered to become more winner-take-all businesses. Airbnb in the hospitality business is able to do things that a single hotel company could not. So as you look at industry economics, those are some of the things you might want to explore. And finally, your company has to be doing something that's going to allow it to increase its market share. Right? And this is where, with companies like Lululemon, you start to think about what do you think their biggest competitive advantage is? Their brand, right? And the problem is brands age over time. So Lululemon is no longer a young, growing brand. They're an aging brand, and everybody's coming after you. And in business, and you see the same thing with Nike, right? One of the great brand names of all time, eventually. So as you look at your company, all of those things play out in what kind of growth you're going to give for your company. Any questions about revenue growth? Ask your final question. Could your revenue growth for your company be negative? Do some companies shrink over time? Yeah. So clearly revenue growth can be negative. So let's look at what has to come through for a company to have shrinking revenues, a minus 5% revenue growth for the next 10 years, which I allow in the spreadsheet. So what kind of companies do you think will have negative revenue growth? Yes. One is you take a company like Altria, Philip Morris, and you say, look, the entire business is shrinking. Your market is aging. And you could say, I'm going to give Altria, Philip Morris, are minus 3% growth over the next 10 years. Brick and mortar retail companies, my base inclination is to give you a negative revenue growth rate unless you're special, right? Costco, I might give a positive growth rate saying, but for most brick and mortar retail companies, I'm saying this is a business that's shrinking. If you're in a market that's shrinking, there's nothing wrong with giving your company a negative growth rate. One of the first questions I ask when I talk to appraisers and analysts is ask them, when was the last time you valued a company where you had negative growth for the next 5 or 10 years? You know the answer often is, I've never done it. And that gives you something about the psychological barrier to putting in a negative number. It just seems unnatural, but leave that door open if your company is potentially a negative growth company. You could argue that companies like Coca-Cola and McDonald's, looking long term, are looking at shrinking businesses rather than growing businesses because of what they sell and what kind of business model they have. So that's the first stop, is revenue growth. Okay? Any questions on revenue growth then? Okay. Let's talk about operating margins. So let's look at the drivers of operating margins. The first is unit economics. What is unit economics? It basically looks at the next unit you sell and how much you make on that next unit. Let's do a contrast here. Okay? Let's take Tesla, their electric car business. What is unit economics? To sell a car, they first have to make it. So the cost of making the car becomes part of the cost you got to cover. So already you can see unit economics are going to reflect that cost. The number that captures this best in an accounting statement is your gross margin. Basically, if you look at a company with a gross margin of 80, 85, 90%, the unit economics are amazing. But if you look at manufacturing companies, the gross margin is going to be 20, 25, 30%, not because they're bad companies, but because you got to make the damn thing first before you sell it. Software companies have high operating margins simply because the unit economics in software are to sell the extra unit, you don't even have to make it, right? It's free. Everything is gravy. So if you look at your company, say, what kind of unit economics? Think about what your company does. Okay. Mondelez has to make stuff before they sell it. The only advantage is, I don't know what the cost of what they make is, but it's a fraction of what they sell it for. Much of it is SG&A and advertising costs. I don't know what Lululemon spends making their apparel, but the number that'll give this away is look at your gross margins. If your gross margins are 50, 60, 70%, you've got great unit economics, you can give your company high operating margins. No. Which brings me to NVIDIA. You know what NVIDIA's gross margins are? It's the highest I've ever seen of a large company. It's 80% gross margins. How does it's a manufacturing company, tech, is it though? It's a chip company, but it's doesn't even make its own chips. TSMC makes them. It's a design. It's more like a software company in terms of what it does. It designs the chips. It makes TSMC. TSMC makes the chips, and it marks them up 900%. And who does it sell it to? Who are its biggest customers? Meta and Microsoft, right? How the hell do you pull this off? Because you see the pressures on both sides, right? If you're at TSMC, my question is, why aren't you asking for a bigger slice of the pie? And if you're Meta and Microsoft, you're saying, why am I paying this 900% market? Why are they right now? Because they've been told that the only way you build an AI data center is with these high-powered chips, and NVIDIA is the only player in town for the moment. Will that change? Absolutely. So if you're valuing NVIDIA, you see what's coming, right? The margins to begin with can stay 50, 55, 60, 65%, but over time there is going to be pressure. Margins are not going to go down to 3%, but they're not going to stay at 65%. That's what I mean by stories connecting to numbers. So when I look at an NVIDIA valuation, I see 70% to start and 60% the end. The question I'm asking is, what's happening to your company? Why are your margins decreasing? And the story you'll tell is, I'm getting pressure from both sides, manufacturing, from TSMC, and from my customers to lower my prices, and that's playing out as lower margins. Second, economies of scale. Great buzzword. But one of the easiest way, when you do a valuation, you increase your margin, say economies of scale. Who can argue with that? But what does that mean, economies of scale?
Somebody give me a something which is less abstract than a buzzword. What does it mean when you have economies of scale? As your revenues grow, your costs don't grow proportionately. They grow less than your revenue. That's at the essence, right? So if a company claims it has economies of scale, what is the first way you can check to see whether that's true? Look at the history. If their revenues have grown 18% a year and their costs have also grown 18% a year, you're going to say, what economies of scale? If there are economies of scale, you should see the cost items that 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 are part of that economies of scale grow at a slower rate than the revenues are. Are there business with economies of scale? Absolutely. But there are limits to economies of scale. Let me explain. If you're valuing Chipotle and your margins right now are like 16%, which is where they are, and you make them go to 25% in your valuation, there's their economies of scale. I'm going to push back on you. Chipotle is already a big company. When you get that big, your economies of scale start to run out of steam. If you're a small restaurant company, you're doing kava, and you say, look, I think economies of scale are going to improve margins, I'm willing to listen. It's a small. So when you talk about economies of scale, factor in whether much of it has already happened or whether you have a runway ahead of you. Third, all too often you'll have people say costs are going to go down, therefore my margins will increase. This is the AI story I keep hearing for companies, right? Grocery stores are going to become more profitable. Why? Because they will use AI to reduce their costs of inventory and other. What's the flaw in the story? Let's say it's true that AI will reduce your costs of doing business. Why might it not play out as higher margins?
The cost of AI.
The cost of AI. And the other thing is, if everybody has AI, what's going to happen? All grocery stores are going to have lower costs. And the nature of the business universe is if everybody has lower costs, guess who ends up benefiting from those lower costs? It's customers, right? This is why the internet did not improve the profitability of every company. Social media didn't improve this. There are people who will make money on AI, but I can almost guarantee you for the rest of the world, it's going to become a cost, and I'm not sure it's going to show up as higher margins, because if everybody has it, nobody has it, because effectively you can't take advantage of it. So if I hear about a cost going down, I want to also hear your story about why it's going down just for your company. Maybe it's proprietary AI that works only at your company. Then I'm willing to listen to that improving margins. So all of those things go into your target margin. And second, you got to tell me how quickly you will get there. So let's say your margins right now 4%. Your target margin is 10%. You can get from 4 to 10 next year. 4 to 10, does it make a difference? Absolutely. But whether you will get there slowly or quickly will depend on what the management is focused on. If the management is focused on growth first, I can almost guarantee that the speed with which you move to your margins is going to be slower because you're going to be focused on growing, and then worrying about margins later. Your business model will matter, and the trade-offs that the business makes will drive how quickly you move it. So one of the inputs you will see in that Ginza spreadsheet is when will you reach your target margins? How the heck do I know? Look at your company. Look at what they're focused on. If they're growth focused and their business model is going to be slow to adjust, it might take a much longer time to get to your margins. But your margin matters. And you can't arbitrarily take a manufacturing company and give it 60% margin just because you like the company. I love Costco as a company. I don't think its margins will ever exceed 6 or 7%. It's a great company at 7% margins. It's undervalued as a company, but it can't get to 30, 40, 50%. It's not that kind of business. There's one aspect of Costco, though, where their margins could potentially be higher. How many of you are Costco members? A lot of services. Have you noticed a lot more services now that you can get through Costco? No. You can get your roof replaced, your air conditioning. Those service businesses are higher margin businesses for Costco than their traditional retail business. Costco travel. I do all my car rentals through Costco. I get great rates. That's a much higher margin business. So if you're telling a story about Costco where their service business is growing, you could actually argue that that could push up their margins over time. But that's the kind of thing that will allow you to push margins up from what the traditional margins have been to a higher number. And the key word is story. Explain to me what you think will happen to your company that justifies those higher margins. Which brings me to the third and final input. And this will be the toughest one for you because it doesn't have the intuitive link that both revenue growth and margins have. Remember I said to grow, you got to reinvest. The sales to capital connects your revenue forecast to your reinvestment. Or intuitively, if you want to grow your revenues a lot, I'm going to ask you to set aside more money. In what? Whatever you need to do to grow. So if you're a manufacturing company, to grow your revenues, what do you have to do? You got to build assembly plants, factories, equipment. If you're a pharmaceutical company and you want to grow, what do you have to do? You have to invest more in R&D. So it doesn't have to be the same item, but I'm looking for reinvestment. And to connect your revenue growth to reinvestment, I'm going to look at a ratio of revenues to invested capital. That invested capital is exactly the same invested capital we talked about in the context of a return on invested capital, but in the numerator here, I look at revenues. The way to read this number, if your sales to invested capital is 3, for every dollar you invest, you get $3 in revenues. So you're a company that's very efficient, low capital intensity company, you should get lots of revenues per dollar of capital invested. If you're a company with huge capital investments, you're an infrastructure company, you're going to have a much lower sales to capital ratio. So again, you can't just sit there and make up a number. It depends on the business you're in. But there are a couple of caveats I would add. You can look at your company's history in terms of sales to invested capital. Yesterday, I was looking at a valuation that somebody sent me for a real estate company in the Middle East with a sales to invested capital of 0.30. My first reaction is, if you leave the sales to capital ratio at 0.30, this company is going to crash and burn. You can see why, right? If your sales to capital is 0.30, what's happening? You invest $1 in capital, you get 30 cents in revenues. Already everything else is going to start to look terrible. So you're saying, but that's a history. You're right, that's a history. They've been building a lot of real estate developments, but as this is one of those cases where as you grow as a company, your sales to capital ratio should improve because you'll be able to live off investments you made in the past. So when you look at your company, look at the sales to capital ratio, you're going to look at their scaling effects. You're also going to look at whether there's excess capacity. Talk about another valuation I got, a valuation of Boeing that I got yesterday. They're putting, I think the revenue growth used for Boeing for the next 10 years is about 15%, at least in this valuation. You're saying that's really high. You know why the 15% actually is not unreasonable? Boeing in 2024 sold fewer aircraft than they did in 2019 or 2015. The companies had a really bad 10 years. And you don't need to ask me why, because you can look at the history of, all kinds of bad things have happened at the company, many self-inflicted. So what this valuation was effectively doing was taking those low revenues in 2024 and bringing them back to 2019 revenues. So it wasn't even a growth to some new level. It's just selling as many aircraft as they did in 2019. You see how they're going to pull this off? There are only 2 players in this game, right? Boeing and Airbus. And I promise you, Airbus is going to have its own problems because this is when one company goes through problems, the other does. So the growth, I said, that makes sense. And then I got to the sales to capital ratio, and they'd use Boeing's historic sales to capital ratio to require a huge amount of reinvestment. That part doesn't hold up, and here's why. What's Boeing going to do? Produce as many aircraft as they did in 2009. They already have the capacity to do that. They got almost free growth for the next few years because they can live off excess capacity. Cruise line companies, after they came out of 2020, many of them you could put high revenue growth rate, no investment needed because you already had the cruise ships. So look at excess capacity and whether the company can get away with that excess capacity. When I valued Tesla 2 years ago, right after they finished their Shanghai plant, I gave them a high sales to capital ratio, at least for the next 5 years, because they'd built enough capacity to be able to grow without building new plants for the next few years. And finally, in some businesses, there is a lag between when you invest and when you see growth. You give me my favorite example. Novo Nordisk. Is it having high growth right now? Kind of. And not as high as people thought it was 2 years ago, but still high. Coming from what? Wegovy and Ozempic, right? Do they need to reinvest to get that growth? No, Wegovy and Ozempic were created from R&D done 10 years ago. With pharma companies, what you're going to get as growth in the next 10 years will reflect reinvestment made in the last 10 years. Which means when you project growth out for these companies, you can have a high sales to capital ratio, low reinvestment because they've already done the bulk of the reinvestment. Same thing with infrastructure companies. You invest first and then you grow. You can get that mismatch between revenue growth and reinvestment because of the kind of companies. So if nothing else, I'll send you the link to the valuation spreadsheet. Open it up and at least start thinking. Don't put numbers down until you've started thinking about your company and the things we talked about. And then start to enter the numbers because your story will drive your numbers. I will see you on Wednesday.